All right, let's get started. Good afternoon, everyone, and welcome to today's Income Wednesday webinar. My name is Prakash Vijayanath. I'm a senior analyst here at OptionsPlay, and today I will be going over the wheel strategy, which is a powerful income generating strategy. So OptionsPlay, in partnership with TMX, have partnered up to help bring you a new platform, much more content and much more education as well. So one of the educational series that we will be doing is the Income Wednesday webinars. And my main motivation for starting the Income Wednesday webinar was simply due to the fact that I feel that options are somewhat being misused in, when it comes to the trading environment. And the reason for that is I feel like they are just being used too much for speculation, when there are actually powerful income generating methods derived from options. So Income Wednesdays is a series every 2 weeks, every second Wednesday, that helps you realize helps you understand certain income strategies in relation to options. And for today's webinar, we're actually starting off with the big strategy, which is the wheel strategy itself. So the wheel strategy actually has two main components to it. It's cash secured puts and covered calls. I'm sure those of you that have traded, over the last few years, you may have come across these income generating strategies. But the wheel strategy has these two main components. It's pretty much an amalgamation of both of them. And yeah, it's a very, very powerful strategy. A lot of nuances, a lot of best practices to follow with it. But for today's session, I plan to go over the wheel strategy, and then over the next few weeks, we'll be taking a look at its components in a bit more detail. So we'll be taking a look at covered calls, as well as cash secured puts in a lot more detail. All right, so before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today will be kicking off with, covering the wheel strategy in a nutshell. What is the wheel strategy? So we'll be taking a high-level view of the wheel strategy. From there, we'll be moving on to taking a review on cash secured puts and covered calls. Just to get a bit more, a quick review so you understand the main components and how they apply to the wheel strategy. We'll go over an example, and we'll go over what, in my opinion, is the most important part of today's webinar: finding the optimal cash secured puts and covered calls. So this is a strategy that's really made or broken by the strike price and expiration date selection. So finding an optimal, the optimal strike price and expiration is very, very important for the strategy to work out well and for you to maximize the strategy. So the main question that I would like to help you answer today is, how can I maximize yield and participate in capital appreciation using options? So a pretty loaded question, right? You want to maximize yield or income, but you also want to participate in capital appreciation, i.e. you want the stock to actually move higher that you own. Well, the wheel strategy is a perfect strategy for that. It helps you generate a nice continuous income stream, also helping you participate in the capital appreciation by owning the underlying stock. So I know there's quite a lot to wrap your head around, but what you need to know from today is get a broader sense of how the wheel strategy actually works. And over the next few weeks, we'll actually be diving deeper into its main components, so you'll understand the smaller things about the wheel strategy as well. So what is the wheel strategy? The wheel strategy is a very powerful strategy that uses options to help you generate a continuous income stream. It helps you purchase stock at a discount, and it helps you participate in capital appreciation. Now, this is the one you want to remember the most: participating in upside capital appreciation. That is the main priority. Yes, income generation is always welcome, but capital appreciation of the underlying stock will always trump that income generation. The income generation by selling an option or the money you receive from that is always going to be smaller compared to what you could potentially be getting from the capital appreciation. So I'll say it once, and I'm going to repeat this, quite often. Always prioritize the capital appreciation. Use the income that you receive as a bonus. Now, so quite a few things to remember here for the wheel strategy. And on the right-hand side, there's a diagram here that kind of roughly paints what the wheel strategy is. There's two parts in green at the top and the bottom. These represent the two main components of the wheel strategy. The first component is the cash secured put component. So all you do here is you sell a put option and you set aside enough money to buy the underlying shares, because what happens if a put option gets assigned? Remember, you're not the driver, you are the passenger here. So if your put option that you sold gets assigned, you are obligated to purchase 100 shares of the underlying at the strike price of that put option. Now, that leads me to my next point, is that there are two outcomes that can happen. One is that you do get assigned, but the other outcome is that your option is expired worthless. So if I sold a put option, the stock is trading at 100, I sold it at 90, and let's say that underlying stock, by the time we get to my expiration date, the underlying stock didn't come down to 90. I won't get assigned. It's only at 95, for example. What happens is then, the put option expires worthless, and I get to keep that premium I received from when I sold that put option. I get to keep all of it, right? Happy days. And I am going to simply rinse and repeat this strategy until the second outcome happens, which is I get assigned. Now, you get assigned when the underlying stock moves below the strike price of the put option that you sold. Now, like when you get assigned, you have to purchase that stock at the strike price. And remember, this is a positive outcome. You want to actually get assigned. The cash secured put component of the wheel strategy helps you purchase that stock and helps you purchase it at a discount by two ways. One, it can by using a strike price below the current price of the underlying, it forces you to wait for a dip in the price of the underlying before you purchase it, rather than simply buying it at today's market price. And the second reason is that it creates an income stream, right? It creates a continuous income stream as and when this expires. Every time you sell a put option, you collect premium, and therefore you generate some income, and that income can be used to offset the initial cost of when you buy that stock. So if I receive $2 per share in premium, and when I sold a put option, and I get assigned, and I get assigned to purchase those shares at 95, I could use that $2 to offset my cost to $93 a share. It may not be much, but if you rinse and repeat the strategy a couple of times, you'll notice that those premiums tend to add up quite nicely, and it skews that risk to reward nicely in your favor. Now, so again, just to reiterate, yes, if you get assigned, you actually view this in a positive way. This is a positive outcome. You want to own the underlying stock. And the reason you want to own that is to, one, generate more income, and two, to participate in the capital appreciation. When you own the underlying stock, when the stock moves higher, that is called capital appreciation, and that is where you really generate your gains, more so than from generating it from income. The income, like I said, is simply a bonus. But once you own the stock, you can start to utilize a different strategy, and that is to sell a covered call. A covered call is simply selling a call option using the 100 shares of the underlying stock as collateral, and when you sell a call option, you collect premium. And again, very similar to a cash secured put, where there's one or two outcomes, right? If you don't get assigned, i.e. if the underlying does not reach the strike price of the call option, it will expire worthless, and you can simply rinse and repeat the strategy, collecting premium and generating a continuous income stream. But let's say, during this time, because you actually own the underlying stock, you are also participating in the capital appreciation. So the wheel strategy is actually a short-term bearish, long-term bullish strategy. It's short-term bearish because you want the stock to initially dip, so you get assigned those shares, and then it becomes long-term bullish because you actually want to participate in the capital appreciation, but you don't want it to be you don't want it to rally too quickly, right? Because then you might actually get assigned very quickly to sell the shares when you sell a covered call. Because when you sell a covered call, you have an obligation to sell the shares to the option buyer at the strike price. So it is moderately bullish, but short-term bearish because we want to keep generating this income stream. That being said, the mentality of the real strategy of covered calls is actually quite interesting because, many of us, if I asked you now, would you want to be assigned on a covered call? I'm sure many people would say no, you want to hold onto your stock almost indefinitely. However, when you use the correct settings in terms of expiration dates and strike prices, getting assigned on your covered call and having to sell that stock actually becomes a positive outcome, because what you'll realize is that you're actually selling that stock when price is overbought or has rallied significantly in a short period of time. And I'll show you what I mean, once we get to the optimal covered call section. But do not view that in a negative light, that if you get assigned a little bit too early, fine, maybe. But, by utilizing the best practices, you can help reduce that probability of getting assigned early and really maximize not just your income stream, but also your capital appreciation as well. All right, so enough of that diagram. Let's take a quick review on the covered call. I know I explained it quite a bit there, but the covered call is an income generating strategy that requires one prerequisite. That prerequisite is to own 100 shares of the underlying or of an underlying optionable stock or ETF. From there, you would sell a call option. You use those 100 shares as collateral and receive a premium. And this creates an obligation to sell those 100 shares of that stock or ETF at a specific price or the strike price. Now, as you can see on your diagram on the right, this is actually a bullish strategy. So the more the underlying moves, or the higher it moves, the more profitable it becomes up until a certain point. Now, this certain point is the strike price of the underlying. So let's say, for example, stock ABC was trading at 100. You buy it at $100 a share, and you buy 100 shares. So initially $10,000 initial investment, right? Now, as long as ABC continues to rally, you're actually in a profitable position. But if you sold a call option with $110 strike, what happens is, as long as if ABC rallies past 110, your profits will be capped. And the reason for that is, if you get a side and if you have to sell at 110, your actual profit will always be $10. So whether ABC is at 150 or 200 even, you have to sell it at 110 because you sold a call option, which creates an obligation to sell the stock or ETF at that strike price. So that point over there represents the strike price, and that is when you don't see further gains from that rally. Now, what is a cash secured put? So a cash secured put or a cash covered put, I prefer using the word secured, but many people use cash covered puts. So this is I would view it as a stock acquisition strategy as well as an income strategy. Now, the prerequisite here is that you need to have cash readily available to buy 100 shares of that stock or ETF. That's very important. And from there, what you would do is that you would sell a put option using that cash as collateral, and you receive a premium in doing so. So you generate some income. This creates an obligation to buy the stock or the ETF at a specific price, i.e. a strike price. And again, bullish strategy, right? Because you are selling a put option, and a buying put option is a bearish strategy. Selling a put option is actually a bullish strategy. But the main thing about a cash covered put or cash secured put is that you want to own the underlying. So you are selling it to generate some premium, but your priority should be to actually end up purchasing the underlying share. So always important to keep that in mind. It's also important to keep in mind that whenever you sell a cash secured put, you need to make sure it's on a company that you're comfortable with potentially owning 100 shares. So this is a long-term bullish strategy, right? You want to be long 100 shares, you have to understand the fundamentals of that company. You have to understand where they make revenue, and you have to truly have a bullish thesis with this company. The last thing you want is to own 100 shares of a company that you don't believe in, or that is failing, or that you simply did on impulse. So always make sure you do your due diligence, and when you sell a cash covered put or cash secured put, realize that it's a longer term bullish strategy, and you will be owning those 100 shares. That is very, very, very important for the strategy. All right, so let's go over an example. And I want to look at this through the lens of a stock-only investor versus a stock and options investor. Now, we have stock ABC here currently trading in 50. And let's say, you have a bullish view on ABC. It's trading at 50, but it looked like after this move, it pulled back a little, and you think it might move a little bit higher, potentially to 58. So what would I do here? I would place a buy limit order at 50 if I'm a stock-only investor, and I'd place a sell limit order at 58. That is my upside target. Remember, I am buying 100 shares at $50 a share. We'll be working in 100 share increments. Therefore, my total risk here is actually $5,000. That's how much money I'm putting aside to purchase these shares, and those shares could move down to zero. So that is my max risk, $5,000. My reward here is $800. $8 differential multiplied by 100 shares gives me an $800 max reward by placing a sell limit at 58. So quite simple. Now keep this example in mind, because what we have here is the comparison between a stock-only investor and a stock and options investor. So for a stock-only investor, we will call him investor 1. And stock and options investor, we'll call him investor 2. Now we currently have ABC at 50, and both of these investors have a bullish view on the underlying stock. But the stock-only investor is not going to use options. He is simply going to place a buy limit order to purchase 100 shares for ABC at $50. This immediately gets executed, and he is therefore debited with $5,000. So he pays $5,000 for that. Now, investor 2, the stock and options investor, instead of simply purchasing the stock outright, what he does is sell one ABC $50 strike put option that expires, let's say, 30 days from now. By selling this put option, he receives $3.15 in premium. This is just an example, by the way, so I know these premiums are slightly inflated. That's just to help go through the example. But this investor sells this put option for $3.15. Now, they are immediately credited. They keep that premium of $3.15 per share, so $315 in total. Now, what does this mean? It means that the stock-only investor simply owns 100 shares of the underlying, simple enough. Whereas the stock and options investor, investor 2, has at $5,000 as collateral set aside, but also has now generated an extra $315 on top of that. And the reason for that is they sold the put option, which creates an obligation to buy 100 shares of ABC at $50 a share. So quite straightforward, but already the investor 2 has now generated a little bit more return here. Now, let's say 30 days later, the put option expires, worthless, right? That's the expiration date for the put option. And ABC has only rallied to 51, which is a 2% gain or $1 gain. Now, investor 1 naturally has made $100 in unrealized profit, which is 2% because they own 100 shares and each share moved up by 1. Whereas investor 2, what happens here is, remember, they sold that put option with a strike price of 50. ABC's at 51, so therefore it expires worthless. It does not get assigned. And again, they still get to keep it full $315, which they always had, which represents a 6% gain. So even though investor 2 does not own the underlying shares just yet, compared to investor 1, investor 1 has only made 2%, investor 2 already on 6%. Also, what you'll see here is, this is what I mean by using the income to offset the cost price of the shares. We have a stock break-even. Now, a break-even price for a stock, when you're making a stock purchase, is simply the purchase price of that stock, which for investor 1 is 50. However, for investor 2, by generating some income, they have effectively already reduced their break-even price for the overall trade. So let's say let's say it's a get signed. They got assigned when price was at 50. They would still be in a very profitable position, because even though they bought it at 50, and let's say, for example, ABC was at 50, there's no profit on the stock part of the trade. By generating an extra premium, that can be used to offset the max risk or the cost basis of the trade to 46.85. So yes, you might have purchased it at 50, but you actually purchased it at 46.85 because you're using the premium received to offset that cost. That's how you want to think about the wheel strategy. Always reducing your risk by generating premium. Now, that was option expiration Friday. The following Monday, what happens here is that the ABC is still at 51 and investor 2 simply decides to rinse and repeat the same strategy. However, with ABC at 51, instead of putting 5,000 as collateral, he has to put 5,100 as collateral. And in this case, he sells an ABC $51 strike, 30-day option, put option for $3. So he'll have to purchase this at $51 a share if he gets assigned. Again, this reduces the option break-even by generating more premium and offsetting that initial cost. Now, 30 days later, ABC actually moves lower, back down to 50. Therefore, investor 2 gets assigned because the underlying price is below the strike price of the put option, and is therefore has to be credited. So it has to pay 5,100, leaving him with $515 in terms of the premium received minus 5,100. This represents a 10% return so far, whereas investor 1 still at break even because ABC has not moved. So already, even though ABC hasn't moved that much, investor 2 here has generated some nice premium along the way. Now, after that option expiration on Friday, on the following Monday, investor 1 has had enough. He places a sell order for 58 to sell his 100 shares. Investor 2, on the other hand, decides to say, okay, now let's start selling call options to generate more income. He therefore sells an ABC $55 strike, 45 days to expiration call option for $2 per share, or 200 in total. So again, even more premium being added to that, and therefore the option break even continues to decline. So this risk to reward is already heavily favored the investor 2. And 30 days later, or 45 days later, I should say, ABC is now at 52, rallied to 52, 4% gain, but it didn't quite rally to 55, which was a strike price of the call option. Therefore, the call option is expired worthless, and investor 2 is now up $915, represented by an 18% gain. This is inclusive of the $1 net gain, because remember, he also purchased it at 51. It's currently at 52. So that's capital appreciation of $100 plus $815 worth of premium received along the way. That makes up for $915. Now, investor 2 decides, okay, I'm going to rinse and repeat the strategy. I want some more premium. I'm therefore going to sell another call option, 55 strike, 45 days to expiration. And again, receiving $2 per share, or 200 in total. This brings overall premium to 1,015. And what happens 30 days later? ABC experiences a strong rally all the way to 60. Investor 1 sells out at 58, and he gets 5,800 back for selling 100 shares there. Investor 2 gets assigned. They have to now sell 100 shares of the underlying at $55 a share. And they receive 5,500 on top of all the premium they've received along the way. So what does that mean? It means that investor 1 has an $800 realized profit, or 16% gain. Investor 2 has 1,415 profit, or 28% realized gain. This is because of the premium received along the way. So you can see, even though they both had identical bullish exposure along the way, and they both had a trade for the same duration, investor 2 was able to maximize his return by utilizing options, as opposed to investor 1, who only did a simple stock trade. So that is the power of the wheel strategy. That's just quite a detailed example as to how people could use it. But always think about it as a way to reduce your break-even price and generate that income for that, just an additional income for when you eventually do sell your stock. You're making more than just the capital appreciation. That income is a nice bonus. Okay, now moving on to the optimal covered call. The next two slides are the most important for today's webinar. If there's one thing I want you guys to understand, it's going to be the next 2 slides. So when it comes to the optimal covered call, I have BMO here trading at 120. Optimal expiration is 45 days. We have done the hard work for you in this case. We have done a big back test from 2008 all the way to halfway through 2022, looking at all the stocks in the S&P 500. And what we did was we tried different covered call settings to see which yielded the best long-term results. Now, the number that kept on the most optimal days to expiration happened to be 45 days. If you go further out, yes, you generate more premium, but time decay there's very little time decay on those options. And time decay is your friend when you are selling an option. So the fact that there's less time decay doesn't really help the case. It doesn't really make sense to go for a very far of the day option. To put this in perspective, let's say you sold a 45-day call option, and after 45 days, you sold another 45-day call option. Now, during that period, if you just sold 190-day call option, you'd actually generate more premium by selling the 2 45-day call options due to the fact that this theta acceleration closer and closer towards expiration. So it makes more sense to actually to go for the shorter side of the trend. However, if you go too short, if you go to, like, let's say 10 days to expiration, the premium received is too little to warrant the risk of selling 100 shares of the underlying. That's why 45 days is just simply the sweet spot. Now, what we have here are 3 different strikes, represented by 3 different deltas. We have the 128, which is somewhere here. That is a 15 delta. It collects 34 cents or $34 in total. This represents a raw return of 0.28. So that is the premium received over how much you'll be selling it for, over 128, and an annualized return of 2.83%. So if you were to generate the same amount of premium every 45 days, and simply rinse and repeat the same thing over a 1-year period, you would get 2.83% return. So not a lot, but that is a 15 delta at 128. Now the 15 delta, we know what delta means, right? We know that delta means it represents a change in the option price relative to the change in the underlying. However, delta has another meaning. It also means that it gives us a rough approximation of the probability of that strike price getting hit. So there's around a 15% probability of 128 being hit. Now we have the 124 delta. So 124 slightly closer to where price is currently trading, and it collects a lot more premium. It collects $112 in total, or $112 per share. That is a 30 delta, so a 30% probability of being hit, so double that of the 15 delta. Higher raw return and a higher annualized return, naturally. And we have even closer to the strike price of a 40 delta, which is 122, that collects a lot more, 185 in premium, represented by a raw return of 1.56 and an annualized return of 16.5. So obviously, the closer you are to the current price of the underlying when it comes to the strike price, you will be receiving more premium. However, there's also a higher probability of that strike price getting hit, and you'd have to sell your shares. Now, quick thought experiment using the chat window. Which of these deltas do you think is the most optimal for a covered call? Is it the 15 delta, 30, or the 40 delta? Please use the chat window. Okay, I have a couple of 15 deltas. Got a couple of 30 deltas as well, so quite mixed. Yeah, quite mixed between 15 and 30. No one really going for the 40 delta though, which is quite interesting. And that's actually quite impressive that most of you knew that it was a 15 delta. Most people would have said the 40 delta because, hey, I'm generating a lot more premium. Yeah, but if you purchased at 120, you have to sell at 122. You have to generate 185, but you've only made 200 in total for buying 120 and selling at 122. In other words, you've minimized your capital appreciation by going for the higher delta. You maximize your capital appreciation by going for the lower delta. By buying at 120, selling at 128, you've already made $800 capital appreciation, plus the extra $34 in premium received, and you get to live for another day. You get to simply rinse and repeat the strategy once again, collecting even more premium. So that is how you want to view, covered call selection or strike price selection. 10 to 15 delta is the most optimal in the long term, because you get to rinse and repeat it. And when you do eventually get assigned, the fact that there's a 15% probability of that strike price getting hit, it means that there's a very low probability of that, and therefore the underlying stock would have to rally significantly in a short period of time. What happens when when price rallies significantly in a short period of time? It gets to an overbought condition, and chances are there's going to be a reversal lower. So that when price is overbought, that's always the best time to sell anyway. And therefore, by using the 15 delta, it helps. Yes, if you get assigned, that's the reality of a real strategy, but you get to maximize that sale of your shares, as opposed to going for an aggressive strike where you initially generate more premium, but you do not make any capital appreciation on that. So always, always, always prioritize capital appreciation. Now, let's quickly go over the optimal short put. Actually, Gene here actually has a very good point. 0.34 barely covers commission unless you own more than 100 shares. This is not a very profitable idea, of course. But again, this is just a simple example here of the setup. Like obviously, you could go maybe more aggressive on the delta, maybe an 18 delta or so, and generate a bit more premium. But the whole idea is that the lower the delta, the better, because you get to maximize the capital appreciation if you eventually do get assigned. Now, when it comes to optimal short puts, we've again done the heavy lifting for you, and we found that it's 30 days to expiration for the optimal cash secured put. And again, we have 3 different strikes. All strike prices are below the underlying price. So we have 74, 40 delta clicks 2.47. We have 30 delta at 72. And the 20 delta at 70. So again, remember the probabilities for the deltas and the fact that the high deltas collect more premium, but also have a higher probability of being hit. Going to run the same thought experiment. Guys, what do you think? 40 delta, 30 delta, or 20 delta for a cash secured put? Which one do you think is the most optimal? Please use the chat window. Thank you. No, I've got 20s, got a couple of 40s. Okay, mixed between 20 and 40, but most people are actually saying 40. And that is, again, the correct answer. The reason being, remember, you want to prioritize actually owning the stock. So you want to get assigned very quickly. You just want to generate some premium in doing so. But by using a 40 delta, by using a more aggressive strike price that's closer to the underlying, it allows you to actually own the shares or have a high probability of owning the shares. So you get to participate in a capital appreciation, and also in this case, collect more premium. So that is why when it comes to cash secured puts, you actually go a lot more aggressive on the delta. Covered calls, you go a lot less aggressive. So 40 delta for a cash secured put and 30 days to expiration. Those are really the 2 optimal settings for a cash secured put. So with that, that is all I have for you today. I'd like to open the floor to a few questions. I only have a couple of minutes here, but please use the Q&A window. Thank you. Any questions you may have? Okay, well, if there aren't any questions, again, thank you guys so much for joining me. I'm really excited about the Income Wednesday webinar series, and the cadence will be every 2 weeks. So in the next couple of weeks, we'll be going over covered calls in a bit more detail, especially with the trade management of covered calls. I feel like that's where a lot of investors initially don't know what to do. So I really hope to have all of you there. And yeah, I hope you all have a great remainder of the week, and I will see you then. Goodbye, everyone.